Hi, I'm Aradhana Aggarwal. I am a CPA and my goal is simple to help everyday people understand taxes without fear, confusion, or jargon. Have you ever thought why RSUs create huge tax bills even when you didn't sell anything? I hear all the time, I didn't sell any stock, so why is my tax bill so high? If you receive RSUs, this video is for you because RSUs are one of the most misunderstood forms of income and one of the biggest sources of surprise tax bills. Here is the core issue. People think taxes happen when you sell stocks. That's true for some investments, but not for RSUs. With RSUs, the IRS says you got paid when they vested. Whether you sold the stock or not is irrelevant to the tax bill. Let's simplify this. When RSUs vest, their value is treated as ordinary income, just like salary. That income shows up on your W-2, is subject to federal tax, state tax, social security tax, and Medicare. So even if the shares stay in your account, the IRS already considers you paid. Emotionally, you feel nothing happened. Tax wise, a lot happened. Here is where things really go wrong. Most companies withhold taxes on RSUs at a flat supplemental rate. That rate is often too low for high earners or not aligned with your actual tax bracket. So you think taxes were already withheld, I'm covered, but in reality, you are usually under withheld. And that gap shows up at tax time. This is how people end up owing tax on income that no longer exists in value. Another issue, RSUs stack on top of your salary. They can push you into higher tax brackets, phase out deductions or credits, and trigger additional taxes. So the tax impact isn't just the RSUs themselves, it's how they affect everything else on your return. Smart planning does not mean avoiding taxes. It means understanding vesting schedules, adjusting withholdings or making estimates, deciding whether to sell immediately, and planning around bonuses and other income. RSUs aren't bad. Unplanned RSUs are expensive. RSUs don't create tax problems just because they are complicated. They create tax problems because people treat them like investments instead of what they actually are, which is compensation. Once you understand that shift, the surprise tax bills stop being surprises. Thank you for watching. Follow us for tax education that's practical, legal, and designed for people whose income isn't just a paycheck anymore. Also, subscribe to our free newsletter, link provided in the comments below.